I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, August 1. The economy is technically in a recession, inflation is high, and the Federal Reserve is aggressively hawkish. And yet, July turned out to be the best month for stocks since November 2020. The S&P 500 jumped 1.4% last Friday, bringing its gain for July to 9.1%. That's the best single-month performance since the first announcements about an effective coronavirus vaccine. So, what gives? Well, driving stocks higher have been better than expected quarterly earnings results, positive guidance from the management of bellwether large-cap stocks, and expectations that slowing economic growth will prompt the Fed to ease up on tightening. Let's make sense of the conflicting signals. Last week witnessed the second consecutive weekly gain for the major U.S. and overseas stock indices. Take a look at the following table. The tech-heavy Nasdaq racked up the biggest gain as key big tech players offered a positive assessment of future growth prospects. The EAFE popped higher for the week as the Eurozone posted stronger than expected economic growth in the second quarter. Despite the geopolitical battle with Russia over energy supplies, the Europeans are making huge strides in finding alternate sources. Back here in the U.S., economic growth has slowed. However, many analysts have been reluctant to officially declare a recession because jobs growth and consumer spending remain strong. As for inflation, it's still too hot for comfort. The BEA reported last week that the U.S. Personal Consumption Expenditures PCE price index jumped 6.8% year over year in June, the highest reading since January 1982, and above the 6.3% posted in each of the previous 2 months. The following chart from the International Monetary Fund breaks down the main drivers of PCE inflation. The IMF notes, however, that it expects inflation to moderate in 2023 as slowing economic growth takes pressure off overburdened supply chains. To combat inflation, the Federal Reserve last week boosted interest rates by 0.75%. Probably the most important signal in the wake of last week's Fed meeting was the significant move downward in Treasury bond yields. This yield action represents the market sentiment that inflation and economic growth may be slowing and the central bank may move less aggressively in the future. Since their mid-June highs, the 2-year yield has declined by about 50 basis points and the 10-year yield by 75 basis points. The decline in yields has in turn supported the robust stock market performance in July, particularly in growth sectors. Also supporting strong equity performance has been healthy earnings growth for the S&P 500. For the second quarter of 2022, with 56% of S&P 500 companies reporting actual results, 73% of these companies have reported a positive earnings surprise, and 66% reported a positive revenue surprise. For Q2 2022, the blended earnings growth rate for the S&P 500 is 6.0%. These numbers come from research firm FactSet, and they're up to date as of market close Friday, July 29. The energy sector is reporting the highest year-over-year earnings growth of all 11 sectors at 290.3%. Higher year-over-year oil prices are contributing to the year-over-year improvements in earnings for this sector. The average price of oil in Q2 2022 was about $108, 64% above the average price for oil in 2021, which was about $66. Oil now hovers below $100 per barrel. In the week ahead, we face another busy week of economic data. Here are the reports from Monday and Tuesday. Manufacturing and vehicle sales numbers will dominate. Wednesday and Thursday, keep an eye on services and jobless claims. And Friday, when several employment data points will take center stage. Amid all of these conflicting signals, how should you trade? I bring your attention to my longtime colleague, Dr. Stephen Leeb, the chief investment strategist of our premium publications, The Complete Investor and Real World Investing. I first started working with Steve way back in 1990. Over the past 3 decades, through peace and war and bull and bear markets, Dr. Leeb has proven uncannily prescient in his predictions about investments. Now, as we face hotter inflation and historic commodity demand, Dr. Leeb recommends you buy a small-cap stock that's uniquely positioned to dramatically profit from rising prices. For details, click the URL at the bottom of the article that accompanies this video on the Investing Daily website. And if you have any comments or questions or any sort of feedback, please don't hesitate to send me an email. You can reach me at mailbag@investingdaily.com. Well, that's it for today. Thanks for watching. Stay safe and healthy out there and stay invested.